Imagine this, you can make millions before 30. How? Well, some people are doing it with something that's a little secretive, a lot profitable, and only for the wealthiest people out there. We're talking about hedge funds. You've probably heard the name before, but what exactly do these guys do? Well, by the end of this video, you will understand just how hedge funds work, why they make insane profits, and how they seem to get away with everything. Stick around, you're about to learn about some of the most powerful, profitable players in the financial world. And trust me, it's not as complicated as it sounds. So, first things first, what is a hedge fund? Let's keep it simple. A hedge fund is basically a pool of money from wealthy people, institutions, and even corporations. They take that money and invest it in, well, almost everything: stocks, bonds, real estate, and even more exotic stuff like art and commodities. They're kind of like the wizards of Wall Street, except they're expected to always make money no matter what the market's doing, unlike mutual funds or index funds. Hedge funds don't just stick to buying and holding, they're more aggressive. These guys are expected to beat the market every single year, which is a tall order. If the market's booming, they're supposed to make even more money. If the market's tanking, they need to have predicted it and made a plan to profit from the decline. That's the first rule of hedge funds: never lose money. Sounds simple, but it's way harder than you think. Here's the kicker: hedge funds aren't open to everyone. While regular folks can buy into mutual funds with a few $100, hedge funds only take on the ultra wealthy people with a net worth of at least $1 million or an income of $200,000 a year. So, yeah, this is not your average investment pool, and it gets better or worse. Depending on how you see it, hedge funds are only lightly regulated. Think of them as the cowboys of finance, while traditional funds have to follow a whole bunch of rules. Hedge funds are free to do their thing with fewer checks and balances. They don't have to report their trades right away and can keep their strategies secret for longer. That's why a lot of people are a bit suspicious about them. They're like the James Bonds of the financial world, doing things in the shadows that regular investors can only dream of. Let's talk about the juicy stuff: how hedge funds actually make money. Unlike traditional investors who stick to buying stocks and bonds, hedge funds are all about taking risks to maximize returns. They use things like short selling, leverage, and derivatives. Let's break down what those mean. Short selling. Imagine you think a stock's price is about to drop. You borrow shares from someone, sell them, and then wait for the price to fall. If it does, you buy them back at a cheaper price and pocket the difference. That's short selling. It's risky because if the stock goes up instead of down, you lose money. But when it works big. Leverage. This is using borrowed money to increase the size of your trades. So, let's say you have $1 million, but you borrow $4 million to make a bigger bet. If the trade goes well, you make a lot more. If it doesn't, well, you lose a lot more too. It's a high stakes game. Derivatives. These are financial contracts that get their value from something else, like a stock or bond. Think of them like betting slips for the financial markets. You can use them to hedge against risks or make speculative bets on how things will change. But just like betting, you can either win big or lose big. Okay, so here's the thing. Hedge funds make money even when they lose. How? Well, their fee structure is something called 2 and 20. Let me break it down to 2%. Management fee. They charge you 2% of the total money you invest every year, regardless of whether they make a profit. So even if they don't beat the market, they're still raking in cash just for managing your money. 0.20% performance fee. If they do make money, they take a cut, usually 20% of the profits. So if you make $10 million, they're taking $2 million. Asterisk, it sounds a little crazy, right? But it works because of one simple truth. If these guys win, they win big. The fund I mentioned earlier, Citadel, makes $1.3 billion a year just from their management fees alone. That's before they even make a profit from their investments. You see, the beauty of hedge funds is that they don't just need to make money, they're designed to always make money. Let's take a look at some of the biggest names in hedge funds. These guys are the true legends of the game. For instance, Ken Griffin, the founder of Citadel. Started out trading at 19 with just $256,000. Fast forward to today, and Citadel manages over $65 billion. In 2022, during a rough market, Citadel's flagship fund still made a 38% return. That's a record-setting $16 billion in profits. Then there's Ray Dalio, founder of Bridgewater Associates, who's built a reputation for his all-weather strategy. It's an investment plan that's designed to do well, no matter what the economy is doing, be it boom or bust. Dalio's firm manages over $125 billion and has been extremely successful for decades. But not all. Hedge fund managers are squeaky clean. Steve Cohen, for instance, made billions at Sac Capital, but in 2013, his firm was fined $1.8 billion for insider trading. While Sac was shut down, Cohen just paid his fines and started a new fund called Point 72, which now manages over $30 billion. Now, let's talk about global macro hedge funds. These are some of the biggest players in the game. These guys bet on big picture economic trend things like inflation, interest rates, wars, geopolitics, and even elections. They'll use stocks, bonds, currencies, and commodities to profit from shifts in global markets. Here's a pretty crazy example for you. So, back in the 1990s, the UK had an agreement with Europe to keep the British pound within a fixed exchange rate against the German Deutschmark. But high inflation and interest rates in the UK made it difficult to maintain this fixed rate. Enter George Soros, one of the most famous hedge fund managers in history. Soros hedge fund, quantum fund, borrowed billions of pounds and immediately sold them for Deutschmarks, betting that the pound would fall. And it did. On Black Wednesday, September 16th, 1992, the UK had to break their agreement and the pound plummeted in value. How much did Soros make from this trade? $1 billion. That's a huge amount of profit made from just betting on a currency. Devaluation. Now, let's talk about the most cutting edge type of hedge fund strategy, the quantitative or quant funds. These guys use AI algorithms and machine learning to make thousands of trades per day, trying to find tiny inefficiencies in the market that humans would never catch. The goal is to exploit these inefficiencies before anyone else does, turning them into profits faster than any human could. Have you ever heard of Jim Simons? If not, you probably should have, because his hedge fund, Renaissance Technologies, has delivered crazy returns. His flagship fund, Medallion, earned an average annual return of 66%, which is almost 3 times better than Warren Buffett's long-term returns. To put it into perspective, if you invested $1,000 in Medallion back in 1988, it would be worth around $140 million today. Yeah, pretty wild, right? Jim Simons was a freakish mathematician who worked for the NSA as a codebreaker during the Cold War before starting his hedge fund. It's safe to say he cracked the code of how to make money in the markets. Let's talk about event-driven hedge funds now. These guys focus on betting on corporate events like mergers, bankruptcies, lawsuits, earnings reports, etc. They try to predict how the market will react to big news and then position themselves accordingly to profit. For example, when Elon Musk announced that he was buying Twitter, a bunch of hedge funds jumped in, shorting Twitter stock because they thought the deal would fall through. Other funds went long, buying as much stock as possible because they thought the deal would go through. Well, the deal eventually closed, and those who bet correctly made millions. Let's switch gears and take a look at some of the top hedge fund managers, the true titans of the industry. The first one on the list is Ken Griffin, the founder of Citadel. He started his hedge fund with just $256,000 from friends and family. And now Citadel manages over $65 billion in assets. He's not just good at making money. He's also incredibly good at keeping it. In 2022, while most hedge funds were losing money because of inflation and rising interest rates, Citadel's flagship fund gained 38%, making $16 billion in profit, the largest single-year gain for any hedge fund ever. Then there's Ray Dalio, the founder of Bridgewater Associates, the largest hedge fund in the world. He manages over $125 billion, and he's famous for creating the all-weather portfolio, which is designed to perform well no matter what the economy is doing. Dalio is also known for his radical transparency, where even the lowest employee can call out the higher-ups during meetings. Talk about a culture of brutal honesty, but not all hedge fund stories are success stories. Let's take a look at one of the biggest failures in hedge fund history, long-term capital management, LTCM. This was a hedge fund founded by John Meriwether, a former Salomon Brothers trader. LTCM was staffed with some of the brightest financial minds, including two Nobel Prize-winning economists. The fund used complex mathematical models to make tiny, ultra-safe profits on trades. In the beginning, everything was going great. From 1994 to 1997, LTCM was delivering huge returns. Wall Street was throwing money at them left and right. But then, in 1998, disaster struck. Russia defaulted on its government debt, which was something LTCM's models never predicted. Their trading positions began bleeding billions. And because the fund was so big, its collapse threatened to take down the entire financial system. The Federal Reserve had no choice but to step in and bail them out with $3.6 billion. Now, let's talk about how to actually join a hedge fund. Unfortunately for most of us regular folks, it starts with going to one of the top universities, preferably an Ivy League school. If you're thinking about going down the traditional route, then finance, economics, or accounting is the way to go. But there's also a newer route that's been growing thanks to the rise of quantitative funds math. Computer science, physics, or statistics. Most hedge funds don't hire fresh graduates. They prefer candidates with some experience under their belt. So your best bet is to get hired at a top investment bank like Goldman Sachs or JP Morgan. You'll work in investment banking or sales and trading for a few years and then aggressively network to make the jump into a hedge fund as an analyst. This is known as the Wall Street pipeline. It's kind of like boot camp for hedge fund analysts. Let's talk about what skills you need to make it in the hedge fund world. There are basically two types of people that hedge funds want: gun investors and freakish mathematicians. If you're going down the investor route, you need to master financial modeling, valuation, and industry research. You've got to know how to read balance sheets, analyze companies and industries, and predict which stocks will rise and fall. It's a tough gig, but if you can prove you've got the skills, the rewards are huge. If you're leaning toward the quant route, then you're going to need PhD level math skills. You'll need to turn your statistical models into automated trading algorithms that make money. This is arguably one of the hardest paths, but it's also one of the most rewarding. Just look at Jim Simons and Renaissance Technologies in a hedge fund interview. There's no room for fluff. They want to know if you can make them money. That's it. So expect questions like, if I give you $100 million to invest right now, what's your first trade? They want to see if you've got the conviction to make big decisions. Another classic question might be, a company's stock drops 30% overnight. What's your thought process? They want to know if you can assess risk and react quickly. And if you're going for a quant role, you'll get questions like, you have a coin that flips heads 51% of the time. How would you bet on it? It's all about probabilities, expected value, and risk management. Hedge funds are looking for sharp, quick thinkers who can adapt to any market situation. So there you have it. Hedge funds are high-risk, high-reward investment vehicles that are only open to the wealthy. They make money by using risky strategies, charging massive fees, and sometimes bending the rules. They're full of high-stakes strategies, legendary managers, and huge profits and losses. But if you're up for the challenge and the rewards, then it's the right game for you. If you want to join one, just know it takes serious skill, tons of connections, and a bit of luck. Thanks for sticking around. And let me know what you think about the hedge fund world. Was there anything I didn't cover that you want to know more about? Drop a comment below, and I might make a follow-up video. Don't forget to subscribe, and hit that bell for more content like this. See you in the next one.